So, Adobe just dropped its latest quarterly report, and honestly, the numbers are telling a really powerful story. If you're an investor or even just thinking about it, you absolutely need to understand these results. In this breakdown, we're going to get right into their record-setting first quarter for fiscal year 2026 and focus on the key metrics that show us where this company is actually headed. Let's get into it. All right, here's our game plan. We'll kick things off with the big headline numbers from their record quarter. Then we're going to dig into the subscription revenue, which is really the engine behind their growth. After that, we'll demystify their operating margins. I promise it's not as complicated as it sounds. We'll also look ahead with a key indicator called RPO, talk about why share buybacks are a big deal, and finally, see what Adobe's own forecast tells us about the road ahead. Okay, first things first, the big picture. Let's just take a look at the top-line results that made this such a successful start to the year for Adobe. I mean, these numbers really speak for themselves. Adobe pulled in a record $6.40 billion in revenue. That's a 12% jump year over year. But, revenue is only one piece of the puzzle. They also generated almost $3 billion in cash from operations. That is a massive number, and it shows you just how profitable and efficient the business really is. This is exactly the kind of strong, healthy foundation investors love to see. And you don't just have to take my word for it. This quote from the CEO, Shantanu Narayan, really nails the two engines driving this thing forward. He points out that recurring revenue from their AI offerings more than tripled. That is insane adoption. And at the same time, the core subscription business is still climbing steadily. You see what's happening? They're innovating like crazy without messing with the stability of their bread and butter. So let's pull on that thread a bit more, that subscription revenue. It's truly the bedrock of Adobe's entire financial model. And its consistent growth is, frankly, critical if you want to understand the company's long-term stability and potential. When you map out the subscription revenue over the past few quarters, a really clear pattern just jumps out at you. It's this steady, consistent climb. From $5.62 billion this time last year to almost $6 billion at the end of the year, and now it's over $6.17 billion. This isn't some one-time fluke. It's the kind of predictable, reliable growth that makes for a really strong investment case. And here it is, the headline number for that growth. A 13% increase in subscription revenue compared to the exact same quarter last year. Now, for a company the size of Adobe, hitting double-digit growth like this, that's a huge deal. It's a powerful signal that their products aren't just keeping customers, they're attracting new ones and expanding their reach. It just proves how healthy that core business model is. Okay, next up is a topic that, I'll admit, sometimes trips people up: operating margins. Adobe actually reports two different numbers, and it's really important to get what each one is telling us about the company's actual profitability. So, on the left, you have the GAAP margin. GAAP just stands for Generally Accepted Accounting Principles. Think of it as the official by-the-book number. It comes in at 37.8%, and it includes everything, even non-cash expenses, like stock-based compensation. But then, on the right, you see the non-GAAP margin, and it's way higher at 47.4%. This is the one management focuses on because it strips out those one-off items to give what they feel is a clearer picture of the core business's day-to-day profitability. Both are useful, for sure. So why even show us both? Well, Adobe says it's all about transparency. By sharing the non-GAAP numbers that they themselves use for internal planning, they're basically letting investors see the business through the same lens as the management team. It just helps everyone get on the same page about what good performance looks like. Now, let's pivot a little. We've been looking at how they've performed, but let's talk about the future. We're going to look at a metric that gives us a pretty amazing glimpse into revenue that's already in the bag. It's called Remaining Performance Obligations, or just RPO for short. I mean, this is the million-dollar question for any investor, right? This quarter was great, but how do we know the good times will keep rolling next quarter and the quarter after that? Well, RPO is one of the best answers we've got. So what exactly is RPO? The simplest way to think about it is this. It's the total value of all the contracts Adobe has signed with customers for future work. It's money they've already been promised. It's just waiting in the pipeline to be counted in the coming quarters. It's basically a sneak peek at future revenue. And the RPO figure for Adobe is, well, it's staggering. Over $22 billion. That is a gigantic backlog of future business already locked in. But here's what's even more important. That backlog is growing. It's up 13% year over year, which means their pipeline of future business is getting bigger at the same impressive rate as their current sales. This is probably one of the strongest signs of Adobe's future financial health you can find. All right, so what does Adobe do with all that cash it's generating? Well, one of the key things is returning value directly to shareholders through what's called a share buyback. This is a really important part of their strategy. So, how does this actually work to create value? It's pretty straightforward. First, Adobe takes its cash and buys back a ton of its own shares, 8.1 million of them this quarter. Second, those shares are basically taken off the market, so the total number of shares goes down. That means that every share that's left now represents a slightly bigger slice of the company pie. And the end result? It directly boasts a key metric called earnings per share for everyone who still holds the stock. But look, a buyback is more than just math. It's about the signal it sends. When a company is consistently buying its own stock, the management team is making a huge statement. They're saying, we think our own shares are a fantastic investment. It shows they're confident about future growth and totally committed to making sure shareholders get a return. Okay, let's bring it all home by looking at what's next. We'll check out Adobe's official guidance for the next quarter and touch on a pretty major leadership change that's just around the corner. So looking ahead, Adobe is basically projecting that this strong momentum is going to keep on rolling. They're targeting Q2 revenues somewhere between $6.43 and $6.48 billion. If they hit that, it'll be yet another record quarter. They've also laid out really clear targets for their earnings, which signals that management is confident the business will keep firing on all cylinders. But the report also came with a huge piece of leadership news. After an incredible 18-year run as CEO, Shantanu Narayan is going to be transitioning out of the job. Now, the key thing for stability here is that he's not just disappearing. He's going to stay on as chair of the board to make sure it's a super smooth handover. Still, this is a massive moment for a company that's been defined by one leader for so long. And this really brings us to the biggest question for Adobe's future, doesn't it? With a new leader about to take the reins, can the company keep up this incredible momentum? We know its growth is now deeply tied to its huge bets on AI. And while the foundation is solid and the numbers are fantastic, the real challenge for the next era of leadership will be to make sure this transition only accelerates the next chapter of growth. That's the one thing every investor is going to be watching.